Okay, good afternoon, everyone. Bonjour à tous. Je m'appelle Stephen Tapp. Je suis économiste en chef à la Chambre de commerce du Canada. C'est un grand plaisir d'être ici avec vous pour notre Assemblée générale annuelle. Today, it is my pleasure to welcome Ed Cass for an armchair discussion, and we're going to be discussing Energizing Canada's investment and trade future. Ed is the Chief Investment Officer, or CIO, at CPP Investments, where he works closely with the senior management group to strengthen organizations' investment governance with the aims of generating higher returns. Ed joined CPPIB in 2008 in the midst of the global financial crisis, so we'll talk a little bit about that. He initially headed the Global Capital Markets Group. He's also led the Global Corporate Security Group, the Global Tactical Assets Team, and has been the Chief Investment Strategist and Head of Total Portfolio Management, and was most recently the Global Head of Real Assets before being appointed the CIO. With over 25 years of investment experience, Ed has held senior positions as well at Fortress Management, Deutsche Bank, and TD Securities. And in addition to that, he also found time in his studies to get a bachelor's in science in theoretical physics from my alma mater, Queen's University, and a bachelor in law from York's Osgoode Hall. So that's a little bit of background on Ed, and we're going to have a chat in a second. Before we jump into our discussion, we have some introductory remarks from Carl Burlock from EDC, and that's coming via video. So if I can ask the group to roll that now.
Hello, everyone, and welcome back. My name is Carl Burlock. I'm the Chief Business Officer at Export Development Canada. Je suis très heureux de pouvoir participer à l'AGA de la Chambre de commerce. Et bien que je ne suis pas présent en personne, nos équipes locales sont là avec vous. And from our regional offices in Calgary and Edmonton, our local EDC teams serve close to 3,000 companies across all export sectors of the economy in this province. The Chamber has been a long-standing partner for EDC, and I value our relationship, which continues to grow. Together, we are taking on new initiatives, and many that are international in scope, such as the recent B20 summit and the upcoming trade mission to Japan. For those of you who might be unfamiliar with EDC, we are Canada's export credit agency, mandated to grow trade and develop international business. We do this through financial solutions, trade knowledge, and a network of global connections. For the past 3 years, we've been working towards our 2030 goal. That goal, to increase Canada's share of international trade in a way that helps build a stronger and more sustainable future for Canada, is directly related to this discussion on energizing Canada's investment and trade future. Au Canada, EDC sert près de 27 000 entreprises de toute taille, et nous sommes déterminés à mieux comprendre les stratégies internationales des entreprises canadiennes. To improve Canada's trade performance, we're focusing on those customers' needs to ensure the right support is available for businesses at the right points in their growth journeys. For example, to encourage more small business to participate in trade, EDC is simplifying our solutions, providing more online access, and making our working capital guarantees available directly through financial institutions. For large companies, we're meeting them with more financial capacity and expertise specific to their global plans, while ensuring that we support their supply chain of small and mid-sized companies. And when it comes to mid-sized companies, our objective is to accelerate their international growth. One way we do this is by partnering with the private sector to deploy more growth capital, including for expansion into new markets and for acquisitions in new markets. By understanding their growth plans, we ensure that capital is available at those key inflection points when companies have opportunities to accelerate their growth. To improve Canada's trade performance, EDC is working closely with government and private sector partners to ensure Canadian companies take a bigger role in international opportunities. And we are glad to have the Canadian Chamber of Commerce among those partners. Thank you to Perrin and the Chamber for your continued and relentless championing of Canadian businesses, for always bringing conversations of national importance to the forefront. J'ai maintenant le plaisir de passer la parole à l'économiste en chef de la Chambre, Stephen Tapp, qui animera la prochaine séance. Merci.
Merci Carl et merci EDC pour cet soutien. All right, so Ed, I used to know CPP as CPPIB, but I know you guys have rebranded since CPP Investments. And so most people are probably familiar, but maybe you can tell us a bit more background on CPP Investments and what are some of the big issues that you guys are dealing with right now?
Sure, thank you very much, and thank you for the chance to speak at the annual general meeting. It's always appreciated to get the opportunity to intersect with Canadians. As you mentioned, we've recently rebranded ourselves. CPP Investments is the old CPPIB. CPP Investments is the investment manager for the surplus funds of the Canada Pension Plan. So the Canada Pension Plan itself has been around since roughly 1966. You remember that back in the mid-90s, we had a sustainability crisis in terms of our pension schemes in Canada. As a result of that, the whole system was kind of overhauled, and in 1997, new legislation was introduced to put the plan on, one, a more sustainable footing, and two, to create CPPIB, as it was at the time, to manage the surplus investments. At the time that we originally came into formation, the assets of the plan were primarily just fixed income, so they were literally IOUs written by the federal government and the provinces into the plan. Over time, though, as contributions came in, we started to diversify that and ultimately took on the task of what we call active management, and I can talk a bit about that over time. Over the years, we've grown into an organization that right now manages around 575 billion of assets, the surplus assets. We have 9 global offices. We have roughly 40 different investment departments that invest in everything from private equity to public equity, credit, real estate, infrastructure, and do that, again, on a global scale across different sectors, different geographies. We have roughly 2,200 employees doing that. About half of those are investment professionals. What's on our mind these days? I understood that Danielle Smith talked here yesterday, and she brought up the topic of leaving the Canada Pension Plan. That's definitely been something that our organization is closely following, and I'd like to take the opportunity to say a couple words about that. One of the things that we're charged with as a responsibility of management of the pension plan is to act in the best interests of contributors and beneficiaries, and we think that also entails an obligation to not really decide upon public policy, but to get involved in public policy debates where we think it could impact the sustainability of the plan or the rights of the contributors and beneficiaries under the plan. And I think this is one of those occasions. Obviously, it's a complicated issue. There is no doubt that Alberta is allowed to withdraw from the plan. It's literally in the legislation that a province can elect to remove itself from the plan, but then that's kind of the start of what is a rather complicated process in terms of how does a province actually leave, and crucially, what do they leave with? And obviously, the amount of money that Alberta would be entitled to is one of those things that's on the table, and the Alberta government has put out one number. I think that the number that's been put out is, I'll say it's on the high side. I think there's reasonable interpretations of the legislation, and there is a provision in the legislation that deals with the calculation of the transfer amount, and Professor Toom at University of Calgary has put forward what I think is a pretty straightforward interpretation of that provision that leads to a much lower number, but certainly that's one of the issues on the table. But I'd say the biggest issue from our perspective, the question that I think people should be focusing on, is what is in the best interest of all Canadians, including Albertans, in terms of long-term income security? What's the best footing that you could be put under? Is it through formulating a new plan, or is it staying with the existing plan? And in that respect, I'd like to make a couple points in kind of favor of the existing structure. And one is that the existing Canada Pension Plan is set up to be a risk-sharing plan across all provinces, and that has huge benefits in terms of mitigating risks associated with either bad demographics at any one local province or bad economic outturns. So you get a huge benefit from risk sharing, which makes the plan a lot more safe and ensures safety of retirement income in the long run. Second is it provides for mobility across provinces, and that's something that I think has been very important to a lot of the businesses, especially in Alberta, in the sense of being able to attract labor from anywhere in Canada and bring it into the province with relatively low barriers to entry. So I think that's an important point as well. And lastly, there's the costs, of course, associated with setting up a new plan. So it's a big endeavor to set up a new plan. If Alberta does go its own way, they have to put in place, quote, a comparable plan in order to be able to transition out. That involves a lot of sophistication, involves a lot of cost in terms of setup. It also involves a lot of risk because right now the assets are being managed by an organization, our organization, that's been in existence for over 25 years now, with pretty close to best in class if you take a look at global peers, investment management experience and outturns. So hopefully over time the debate really centers around those issues, about the issues that impact the people that are participants in the plan, and really how do we safeguard their retirement savings over the longer term.
All right, well, thank you for that. I think we will take some questions from the floor after that. I mean, I think you've had a pretty fulsome kick at that one, so let me move on to the next topic. I mean, I said before, you started in 2008 at CPP Investments during the global financial crisis. We're going through a time of significant volatility. We've had the pandemic. We're kind of on the other side of that. But how would you compare the environment from, let's say, 2008-9, where we had a global financial issue, to where we're at now in the cycle, and sort of how do you compare those two?
I think it's a really interesting comparison. As you mentioned in the intro, I was had the good luck to start at CPP Investments back in March of 2008, so literally right before the financial crisis, and headed up global capital markets for approximately 2 years as we worked our way through that. In some sense, there's very real similarities. Obviously, there's a lot of uncertainty in terms of how the economy is going to unfold over the next few years. There's been distress in a lot of asset prices, predominantly fixed income and credit. It hasn't had the same kind of knock-on effects to equities yet. Though, of course, from the kind of heightened equities around 4,800 on the S&P down to 3,600, there's obviously a huge drawdown, but equities have stabilized on a relative basis compared to the other asset classes. But when you look beneath the hood, it's almost the polar opposite, I would say, of the global financial crisis. Global financial crisis, you had a demand problem, but it was the adverse of the demand problem that we have right now. So you had a total lack of demand, you had a negative output gap, you had economy operating below potential. Here you've got the exact opposite set of facts. You've got a positive output gap, you've got an excess demand situation that's putting pressure on inflation. Yes, you still do have that same volatility in asset prices, but it's almost coming from the opposite direction. And I think that's the mistake that a lot of people made when we initially started down this path back in March of 2022, when asset prices started to get hurt. I think the knee-jerk reaction for a lot of people in the markets recently has been buy the dip. If there's a dip, Fed comes in, it will provide liquidity, the economy will be able to recover. But that's in a situation where demand has been hit and central banks are actively trying to get demand back to trend or get output back to trend from the bottom. So it's demand gets hit, try to restore demand. This was the exact opposite of this situation. This was a situation in which we were operating in excess demand. Output was above potential, and now the central banks are trying to bring it back down. So as opposed to a kind of buy the dip mentality, if anything, I would argue it's the opposite. The one other way that I think the market is markedly different than the GFC, though, is the nature of the hit to asset prices. And internally, we talk a lot about kind of colloquially good beta and bad beta, or there's circumstances where the market goes down where expected returns actually go up. And that happens when cash flows aren't really impacted, but discount rates rise. And that's what
we saw that for tech stocks as well. When we saw big changes in interest rates, the tech ones moved very quickly in advance of others, right?
That's right. And it really wasn't a reflection of cash flows being impacted through tech companies. It was just that change in discount rate. And because tech companies have so much of their cash flows back-weighted or very long duration assets, then interest rates move tech company stocks a lot. But that's not a bad thing. If your expected return is going up while your asset prices go down, arguably your forward cash flows don't change at all. That's kind of good beta. Bad beta is where cash flows are actually impacted, and that's what we're looking at in the GFC, where people are taking a look forward and saying, is this company going to survive, or is this industry going to survive, or these cash flows going to be totally wiped out? Good beta and your returns go up prospectively, then you're left roughly in the same position going forward. Bad beta where cash flows are impacted, that's kind of a non-recoverable situation, so it's very bad. So I kind of view this as in the broader context, a healthy market correction where forward cash flows go up. Yes, asset prices might go down kind of in the moment, but longer returns can kind of cushion that blow.
Okay, so you mentioned inflation, and so in Canada right now, inflation rate running at 4% year over year. We've got core rates. So if you kind of strip out some of these volatile energy components or groceries or things that have moved around pretty excessively, even core inflation is pretty high in Canada. The U.S. number just came out today. We're at 3.7, so it's still well above targets of 2% for most central banks. So, how are you feeling about the inflationary environment? You talked about supply and demand. I think we're seeing constraints on supply right now, and we're still seeing pretty strong demand. But what's causing inflation? We have high interest rates, or maybe we'll talk about interest rates kind of after that. But what do you see as the drivers of inflation? And do you think we will get to a point where the Federal Reserve and or Bank Canada can get to this soft landing scenario where we disinflate, we get back to 2% target, and we don't have a major downturn? Is that likely? Because markets have kind of moved back and forth on that over the last, I would say, year or so.
I don't think it's likely. It might be possible, but I wouldn't put it in the likely camp. What is going on in the economy right now? You still have, as we just talked about, excess demand, and you don't really have the supply side levers or the productivity gains to kind of meet that change in excess demand. You're seeing that flow through to wages, which if you take a look at growth in wages, the most recent stats point to still kind of 4 to 4.5% annual growth, which is higher than the kind of long-term output potential of the economy. So
we would need some pretty good productivity numbers to be able to
get up to
that kind of growth.
Yes. Yeah. Which isn't something, quite frankly, that we've experienced globally lately. So if you have global demand, because one person's wages become spending in the long run, outstripping potential of the economy, then you're going to have that impetus towards higher inflation. Fed is obviously trying to pull that back, and they're trying to pull that back by raising interest rates. And if you look at the decomposition of how the market has interpreted that rise in interest rates, it's almost entirely a rise in the real rate. So if you take nominal interest rates and you carve them up into a real rate of growth and inflation, what's been really quite amazing to me is the fact that long-term inflation expectations really haven't budged at all. So you still have inflation expectations at 3 to 5 years well anchored at around 2%. And if you look in perpetuity, it's 2% or even lower. In Canada, it's down like 165, so it's not even at the bank target. So you've seen that translate into the higher real rates. And I think the market's hoping those higher real rates over time kind of dampen the demand such that the economy can land and inflation gradually comes down. I just think that's highly unlikely for the reasons I mentioned. If it does flow through to wages, and you've seen a lot of the recent inflation numbers, inflation's cooling in the manufacturing side, but it's not cooling on the services side. So services inflation's really picked up. I think it is due to that kind of intersection.
And services where you have a larger share of wage as overall costs. And so
exactly. So if wages stay high, service inflation probably stays high. And it's really hard to get out of that kind of trap. Talked about inflation being sticky. That's one of the problems. It's once people, and this is, as an economist, you know this probably better than I, once people get it in their head that inflation is 4%, then they argue for 4%, they start projecting that out in the future, and inflation expectations become embedded. I think part of the issue was the Fed waited a bit too long. If you remember at the start, Fed was talking a lot about transitory. They thought inflation was transitory. They said once the supply chain issues go, inflation will go. They got that wrong. But that period, that 2-year period, was enough to start to ingrain inflation in people's expectations and demand to be compensated for it. And trying to get out of that, I think, is going to be a really tough story.
So you see kind of inflation getting stuck around the 3% mark where we're at, and then having to really keep interest rates higher for longer to force the economy back into balance?
Well, this is, I think, where it gets really interesting. I think you've got to take a look at interest rates through two different lenses. And one is kind of the short-term interest rate path, and one is longer term. And I think one of the things the market's potentially mispricing right now is the fact that if we get through this, if central banks are able to engineer a return to 2% inflation, that does not mean that interest rates go back to the level that we experienced prior to 2020 in our view. So if you think back to the period, and this again has its antecedents in the global financial crisis, coming out of the global financial crisis, you had unemployment around 10%, you had double-digit unemployment. If you thought from a monetary policy perspective where you'd want to put interest rates, you'd want to put them at minus 5%, roughly. Obviously, central banks can't put interest rates at minus 5%, so they put interest rates down to zero.
Then we started buying assets.
And they started buying assets, and they do some quantitative easing because they look for other levers. But the bottom line is that getting from that very high level of unemployment to where we were around 2020, which looked like a more sustainable level, took over 10 years. It took 10 or 12 years of very easy monetary policy, which manifested itself in very low interest rates. That was on the back of, as I said, coming out of the global financial crisis, but also on the back of this tremendous period of globalization, whereby we were able globally as an economy to bring on a ton of surplus labor, which all else being equal would have been deflationary. Now, again, it wasn't deflationary because central banks can see that. They're kind of endogenous to the system. They can see all this excess supply coming on board, and they can adjust monetary policy. Again, they adjusted monetary policy by keeping it low. That's not the world we're in anymore. A lot of the concerns that we're seeing geopolitically, especially in terms of security at the country level, manifest itself in having to build up redundant supply chains, manifest itself in trying to onshore or ally shore supply services. That's not globalization, that's deglobalization. That's not a low inflation world or deflationary world. That's a high inflationary world.
Our previous speaker was just talking about labor shortages as well, demographic factors and others. So I think the idea, at least prevailing market wisdom, is that interest rates will be higher. The neutral rate that policymakers will set will be higher. How do interest rates affect pensions? Because often when you're a saver and interest rates go up, that's a good thing. If you're a borrower, that's a bad thing. But how does it affect the balance sheet of a pension? When let's say we've gone from a lower, sustained level of low rates to higher rates. How do you think about that in terms of your portfolio?
The big change, and I mentioned it before, was the kind of accretion to real rates. And just to put it in context, in March of 2022, real rates were approximately minus 150 basis points priced in perpetuity. So you can take a look at a fixed income curve, and from the different maturities, you can back out the assumptions that are embedded with respect to monetary policy going forward out 30 years. And literally minus 150 basis points real was priced out over the next 30 years. That's a tremendous boon in terms of current asset prices, because the discount rate is obviously very, very low. And we and a lot of other institutions experienced years of, I'll say, kind of earning above potential in terms of returns. Again, going to that good beta, bad beta discussion, it wasn't that forward cash flows were picking up tremendously. It was just that discount rate was going down, which means you got an appreciation in kind of spot prices, but your forward returns were going down. Your expected return out 30 years was a lot lower than it had been starting that period. What we've gone through right now is that that real rate going from minus 150 basis points to, we calculate it weekly, plus 225 basis points right now. So you've had a change of 375 basis points in the discount rate.
And it's only really hitting right now, at least in the Canadian economy. You see it started in the spring of this year, but as you mentioned, the banks were behind the curve. They're raising rates, but inflation was still not coming down yet. So we're not really feeling some of that pain from past interest rate hikes until really right now. And people rolling over mortgages as well will feel that.
Well, you're seeing it in terms of asset prices, certainly in terms of fixed income pricing, and fixed income, the value of stocks and bonds has gone down a lot. You haven't seen it as much in equities because some of the cash flows, positive cash flows, have kind of canceled out against the discount rate change. As you suggest, the old rub about monetary policy or monetary policy changes happens or has effect with long and variable lags. Long lags, most people talk about 18 months, but variable means it could be anywhere from 6 months out to 3 years. One of the things that we've been bandying around a lot internally is why is it taking so long? I'll be perfectly honest, I was calling for a recession at this point, by this point at the start of the year, and obviously got it wrong. And
I think people had even going back earlier, we're about 12 months off when most of the main banks had been starting to forecast, and it's always these rolling horizons, but in the next 6 months or 9 months, we most expect to see a downturn. But that had got pushed out and pushed out. We've seen resilient labor markets. Consumers had still been spending up until more recently. Housing markets have come back. So
yeah, I sort of feel like that cranky kid in the back of the car, are we there yet? Are we there yet? And looking at it in its totality, I think we're still on our way there. So as you alluded to, I think some of those effects are still starting to hit. I think there were things in the system that kind of prolonged the impact of monetary policy. One of them being the Fed and Bank of Canada and fiscal authorities putting a lot of liquidity in the system and a lot of money on people's balance sheets. At one point in the US, there was roughly $2.25 trillion worth of excess savings that were on a household balance sheet. So that's just extraordinary. That number now, though, is running off, and you see it running off at approximately $250 billion a quarter and going to zero roughly this quarter or the next. So there's one big shock absorber that is arguably going to be gone. You've also had Congress in the US pass the IRA, pass the CHIPS Act. So just when you thought the party was ending or the punch bowl was almost empty, the punch bowl got filled up again, and there was yet another load.
And business investment in the US has picked up as a result of that. You can see that in the data of the last 12 months for sure.
Yeah, and that frankly is one of the things we got wrong. We didn't anticipate that, and the level of growth in the US economy has kind of surprised up to the upside. I think you see that definitively in the data. So the question is that going to persist, or is that going to come down over time? As I said, central banks they're trying to push down demand. So they're trying to do it in a sustainable way. And I think their hope is that we're going to have this proverbial soft landing. But certainly if you look back through history at the number of occurrences of a central bank actually engineering a soft landing, if you look across...
There's not too many.
There's not too many. Yeah, you can kind of count them on the fingers of one hand if you look across the last 100 years. And,
well, the Greenspan era, I think, had been targeted, and that's the late 1990s, where he didn't raise rates and the unemployment rate was very low and everybody thought, but then you had IT adoption and this productivity revival, which maybe with AI, you could see that happening in the global economy coming forward if there's adoption. But I think in terms of episodes, there's not many cases where central banks have hit the brakes super hard, and we've been fine.
Yeah, so I think that is the one wild card. And certainly if you look back in history, then you always have to say, why might this time be different? And it's a dangerous question to ask, as we all know, is this time different? The one thing that is definitely out there that the markets are cognizant of is AI. And if there is going to be a path towards a soft landing, I think it's going to be through some kind of productivity boom. And certainly people have speculated that AI could be that productivity boom. Now, I think there's a lot of questions still surrounding AI in terms of can it be translated into the productive sector? What kind of productivity increase does it entail? Then importantly, where does the benefit of that productivity increase go? Does it accrue to corporations in the form of, say, increased margins? I think that's kind of unlikely, especially given the starting point of where margins are. It could easily accrue to consumers in the form of consumer surplus. So we receive a productivity boom, but that results in kind of lower prices across the board through competition, and the consumer mainly benefits from it. I think there's real questions around how that productivity enhancement would be shared in the end. Right now, it's manifesting itself, at least in the way we look at security prices and go-forward expectations of companies, which just kind of outline the reasons why I might not think that's the case. If you take a look at analyst estimates for earnings growth in companies over the next 3 years, embedded within security pricing right now is roughly 9% growth in earnings in the next 3 consecutive years. And just to put that in context, the prior 10 years was roughly 7% on average. So 7% on average earnings growth when you had overnight at zero, where you had a negative output gap, where you had no inflationary pressures, where companies could over-earn, you achieved 7% earnings growth. And if what you and I just suggested in terms of higher interest rates going forward and a hit to demand, it's kind of tough to get from that 7% under a real Goldilocks scenario for company earnings up to a 9% go forward expectation. I think we've got to try and figure out how to close that gap.
So if anybody is looking to ask a question for Ed, you can go up to one of the mics that I can barely see from here. And I'm going to ask you another question while we see if anyone wants to queue up. CPP's got a lot of different offices all over the globe. And Canada, in terms of trade policy, is pushing in the Asia-Pacific region. How do you factor geopolitical risk and look at the overall outlook for, let's say, growth? Because we've always had the view that growth was going to be stronger in emerging markets, in particular in the Asia-Pacific. So, how are you allocating your portfolio there, and how do you factor in any of these risks that may have been higher now than they might have been, pre-Trump world?
Well, I'll start with global growth, and we monitor, of course, developed market growth, but also emerging market growth and the trajectory of a lot of emerging market economies. And I can say in aggregate, we really haven't seen anything yet that would kind of dispel the thesis that there's still going to be greater than DM growth in EM. I think the days of China earning in excess of 6% or growing in excess of 6% are gone. So I think that's due to a couple factors. One is changing demographics over time. China's demographics, its population is getting older. They can't transition as many people from rural settings to urban settings, so that demographic dividend that they have is pretty much used up by now. But another big factor is the fact that the economy has progressed a tremendous amount. So you have
the catch up, I would say, easier part of when you're, let's say, very far from the productivity frontier is the low-hanging fruit. It gets harder.
That's right. So that low-hanging fruit is gone. The easy money has kind of been made. And now the harder part of convergence is getting over the middle income gap and closing that gap between, say, kind of $15,000 per capita, getting over that $20,000 per capita, and then merging with developed market economies. But if you take a look at China's overall trajectory, it's roughly in line with what we in the past considered to be some pretty extraordinary growers. In the case of Taiwan or Korea, or even going back further, Japan, they're still roughly on that same trajectory. And then India is still in the neighborhood of probably 7 to 8% growth. Still has a demographic dividend that they can rely upon to kind of see a higher level of sustainable growth further out in the future than China. So I think that global growth driver still will predominantly come from EM. When it comes to asset pricing, though, and asset allocation, the factors that you raise are ones that are foremost on our mind. We did a big exercise back in 2015 where we took a look at where we wanted to position ourselves vis-a-vis investment in emerging markets. And we said at that point in time we were going to target being up to 1/3 in EM, or have up to 1/3 of our assets in EM. We recently reviewed that and have cut that number roughly in half. So now we're targeting 16. And there's a couple of reasons for that. One is the one that you mentioned, just increased risk. Returns really haven't changed that much, or expected returns haven't changed that much, but the riskiness of those returns has gone up, but we think substantially. If you factor in geopolitical risk and all else being equal, that kind of makes it less attractive. We also did an exercise where we looked at our investment experience in EM, and it was kind of interesting. When we did that, we did what was called a pulse check. We said, what has our experience been? How much money have we made in EM? And crucially, where did that come from? The end number in terms of our investment experience was roughly what we targeted, but the composition was wildly different. So we thought we'd get roughly 2/3 of our return from systematic exposure to EM in terms of country risk and growth risk, and maybe 1/3 through alpha or security selection. And our actual experience was the inverse of that. So we got much less from systematic risk or exposure to systematic risk and much more from inefficiencies in the market. Going forward, we think those inefficiencies will probably become less, so our go-forward expectation comes down as well.
Okay, so I think people are patiently waiting at mic 3. Do you want to go with your question? And we'll have to be shorter, Ed, on your answers at this point because we have about 2 or 3 minutes left. So
I'm Anita Huberman with Surrey Board of Trade. I just wanted to ask you, as our population continues to age, can we really rely on the pension plan to support Canadians?
So I think what you have to look at when you examine that kind of question is, one, demographics are reasonably well known. I mean, that's one of the nice things about demographics. You can pretty much tell.
Everybody ages one day.
Yeah, everyone ages one day. They kind of do it the same rate. If mortality doesn't change too much, you can pretty easily project what that demographics looks like and how that unfolds over time. And changes in demographics feed into changes in growth, which feed into the expected returns on assets. And we're lucky enough as a pension to have very strong governance in the sense that every 3 years, the Office of the Chief Actuary in Ottawa performs an in-depth examination of the sustainability of the plan over time. And crucially, they spend a lot of time on things like demographics and demographic change, and how does that feed through to sustainability of the plan, both in terms of contribution support as well as to expected returns on assets. And the good news is that that inquiry just got conducted, just got released as of the end of, I think it was our 2021 fiscal year, and the Office of the Chief Actuary said with a high degree of confidence she thinks that the plan is sustainable over not just a short horizon, but over a 75-year time horizon. And
the Parliamentary Budget Office or the other independent assessments have similarly come to the same conclusion that it's sustainable.
So certainly the demographic change has an impact, and that was one of the big features. That was probably the greatest driving feature through the move towards the plan becoming unsustainable in the mid-90s. You went from a dependence or kind of a ratio of 6 workers for every 1 beneficiary to the projections of roughly 2 to 1 or less over time. So that was a powerful impetus, but I think most of that is behind us now. And when we look forward, we're properly calibrating to that kind of slower demographic shift over time.
My clock is in the red. Should I take question from number 3 or should we? It's got to be a lightning round though. You got to be super quick.
Lightning round of questions.
For both the question and the answer.
Oh God, this is going to be hard. Okay, Colin O'Leary with the Kamloops District Chamber of Commerce. So I saw an economist had a really interesting analysis. I also thought we'd be in a recession by now, but what he did is he actually looked and he said, if you look at a GDP per capita, we actually are in a recession. What's happened is with our immigration and all this added capacity that we're adding to our economy, that's one of the factors that's actually kind of stretching out the impact of a recession. And so I was just kind of curious, because we're adding productivity by adding so many people, because we're adding more people to Canada than we ever before. I was wondering if you've done any kind of an analysis. I'd love to hear like an updated version of that. Like, have you even looked at immigration numbers, and do you think that that's having a play on why we're having this dragged out, time period before we hit a recession? That's as fast as I could say it.
Yeah, I think that's more a long-term phenomenon than a short-term phenomenon. And the study that I just referred to, the Office of the Chief Actuary conducts, she has to make assumptions as to immigration over time and immigration trends. And so that does get incorporated within the whole mix. But I think what we're experiencing right now, you correctly allude to the fact our productivity has been lower than expected, but immigration or additions to the workforce has compensated for those. It's kind of kept us roughly equal. But I don't think it's the main driver of the short-term situation that we're seeing in the economy. I don't think that labor can be assimilated productively into the economy quite that quickly. I think there's other things at play, or a confluence of other things at play this time.
Okay, and I know now that I'm in overtime, Christy will not give me any candy. So what I'm going to do is bring Serge up. So Serge Corbet is the Director in Government Relations at Air Canada. He's going to thank our speaker and offer some remarks. There will be a door prize as well prior to the break, so don't go anywhere yet because you might win something.
Thank you so much. Well, if there's no candy for you, but apparently the punch bowl is full now. So that's what we've heard, or it's being replenished. So it's not empty yet. So that's... merci beaucoup. Thank you very much. As mentioned, mon nom est Serge Corbeil. Je suis avec Air Canada, directeur des relations gouvernementales. Je suis basé à Vancouver. I'm based in Vancouver. I come and I cover the West and the North for Air Canada. Thank you so much for this very enlightening and interesting panel today. As I was sitting there, I was thinking of, one of the questions a lot of people ask that I think about anyway, and I think when you responded to Anita's question, you reassured all of us. The question is always, will there be enough money? And as somebody who's, started contributing to CPP about 45 years ago and looking at the end of the tunnel, which is the retirement that's coming soon, I'm happy to hear that there is enough money. And thanks to you and your team for the work you do on our collective behalf. And as I was listening to your remarks and some of your answers, I was thinking of our industry, the airline industry, and how, the changing economics, the risk around the globe, the geopolitical events that are happening that are impacting how you see the world, how the investments are doing. It really relates to what we do as well in terms of our own industry as a global airline that flies out of Canada to 185 cities in Canada, the US, and around the world. We're impacted constantly on what's happening around the world. And we've had our share of those challenges over the last 3 to 4 years. And just to perhaps borrow an airline analogy, we do have a flight plan, as you do. We're reaching our cruising altitude, but there's a bit of turbulence on the way up. And from your remarks, I was also thinking that perhaps the pilot will have to maybe keep the seatbelt sign on for a little longer. So again, thank you very much for your words. At Air Canada, we're very proud to be a member of the Canadian Chamber of Commerce and to be a sponsor of this AGM and convention. We're also a member of many of the chambers across the country. We fly to about 51 airports in Canada, and we have some deep relationships with a number of our chamber partners. We really appreciate the work and the policy work that goes on at the Canadian Chamber, but at chambers also across the country. That work is very important. It enlightens and informs our policymakers, and the way that chambers come together to put those policies together is really interesting. We pay attention to the work you do because we're part of the economy of Canada. We're part of the economic fabric of this country. Everybody has an opinion of Air Canada. I hear a lot about these opinions from time to time when I travel, but some people might not know about our contribution to this country's economy. So I wanted to take maybe a moment to speak to that. We with our partners in the regional airlines employ about 45,000 Canadians. It's plus 5% compared to 2019. We have about $12 billion of expenditures in this country. Pre-pandemic, our total economic output was about $47 billion in this country, 21 billion in direct GDP contribution, and we support about 190,000 jobs across the country, part of the airline ecosystem. And when times are tough, we do step up. Actually, right now, we have our first flight that's coming back from Athens with some of the people that were evacuated by the Canadian military from Tel Aviv to Athens. The flight's in the air. It should land in Toronto in 2-3 hours. We'll have a second one tomorrow. So we're very proud of the work that our teams, our crews are doing to bring back people to Canada. Thank you. Alors, sans plus tarder, je sais que vous avez hâte au prix, and typically when you speak like that and you're between, dinner, the sessions and dinner, people are in a hurry, but now I know you're in between this session and the policy resolution session, so I want you, hold you. We do have an interest. There's a couple of interesting, for us anyway, sessions. One on sustainable aviation fuel. I encourage you to look at it. I encourage you to support it. Sustainable aviation fuel is very important to decarbonize the aviation industry. So without further ado, we'll do the price, and I'll have a bit of housekeeping notes. So may I have not the envelope, but the bowl. One here. And so it's a price for 2 economy class round trip tickets to anywhere we fly in North America, the Caribbean and Hawaii. So that's your choice of about 110 destinations. The winner is Rakesh Naidu of the Windsor Essex Regional Chamber of Commerce.